Imagine this. One stock sitting at the center of a tug-of-war between market fear, institutional strategy, and retail optimism. That stock is SOFI. Today, we're diving deep into its latest movements, the underlying data driving those moves, and why the market's reaction may not tell the full story. If you've been following SOFI closely, you'll know that it often becomes a mirror of broader market sentiment. What we saw today is a perfect example of how economic reports, institutional behavior, and trader psychology all collide to influence where SOFI is headed. Hello, everyone. Welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads and also enter our giveaway. But before that, alert, this is not a financial advice video. Let's start with the basics. SOFI experienced a drop of nearly 1.7%, trading within a range that shows how volatile sentiment has become. Pre-market activity hinted at a rebound after a rough session the day before, but that optimism quickly faded once the broader market opened. Large institutional selling put immediate pressure on the stock, cutting short any chance of early strength. But the real trigger for the day wasn't just technical, it was economic data. The JOLTS report revealed job openings at 7.1 million, slightly below expectations of 7.3 million, while quits came in at 3.2 million, also under the forecast of 3.0. On the surface, this data looks negative. Fewer openings and fewer people quitting imply a cooling labor market, which investors often interpret as a weakness. But here's the twist. Weaker labor data can actually be bullish in the bigger picture. Why? Because it increases the likelihood of Federal Reserve rate cuts. In fact, following this release, the probability of a 25 basis point cut at the September meeting grew, and now there's even a significant chance of another cut at the October meeting. This is where the contradiction lies. Short-term investors reacted negatively, treating the data as a sign of weakness. But long-term, lower interest rates would stimulate borrowing, encourage investment, and likely benefit growth-oriented companies like SOFI. The volatility we saw is a perfect case study in how the market often struggles to reconcile immediate fear with long-term optimism. Adding to the confusion were comments from several Federal Reserve officials who added uncertainty rather than clarity. September already carries a psychological weight in the markets, historically known as a difficult month for equities, and this backdrop only amplified the selling pressure. For SOFI, the story doesn't stop there. On the company-specific front, SOFI announced the launch of a new ETF. Now, let's be clear. ETFs from SOFI haven't exactly dominated the investment world yet. Many of their previous offerings are not widely popular, but the strategy here is brand building. By continuing to expand their ETF lineup, especially with products focused on trendy sectors like artificial intelligence, SOFI is positioning itself for the future. Even if immediate adoption is slow, each launch reinforces their image as a forward-looking financial platform. Over time, these ETFs could become an important revenue stream, adding diversification to SOFI's core business. From a short-term trading perspective, the behavior of short sellers also gave us clues. Today, shorts returned around 132,000 shares rather than pressing harder with fresh positions. That's notable because borrowing costs for shorting SOFI are relatively low, making it cheap for them to increase bets. The decision not to pile on suggests that some institutions may see the recent decline as overdone. Currently, about 9.45% of SOFI's free float is shorted, representing more than 111 million shares, a substantial number, but not extreme by growth stock standards. Options data paints another interesting picture. Around $32 million went into call options compared to $9 million in puts, with 43% of all contracts leaning bullish. But the final minutes of the trading session revealed something worth watching. More than $4 million in premiums flowed into positions between $2.50 and $3, many of them bearish. When large sums like this move right before the close, it often signals institutions positioning ahead of upcoming catalysts, whether that's economic data, market reactions, or company-specific developments. Speaking of catalysts, new labor-related reports are on the horizon. The ADP Employment Data and ISM Services Index are next in line, both capable of shifting sentiment in a big way. If these reports show stability or come close to forecasts, it would reinforce the expectation of Fed cuts without painting the economy as too fragile. That balance could be the perfect setup for stocks like SOFI to bounce. Looking at price targets from traders, there's still optimism. Many bulls expect SOFI to climb back toward the $26 range by the end of the week, while bears argue for a slide below $23.50. That kind of divide tells us one thing: volatility isn't going anywhere. Institutional flows confirm this tug of war. We saw multiple transactions in the millions throughout the day, both in the open market and in dark pools. Whenever big money remains active at these levels, it shows that SOFI is far from being ignored. It's still on the radar of major players. Technically, SOFI closed just below its 10-day moving average, which could signal a period of consolidation or further pullback. Key levels to watch are 24 and 54 on the upside and 23 and 86 as a critical support. For traders, these levels could determine whether momentum shifts bullish or bearish in the short run. Stepping back, though, SOFI remains stronger than many other growth stocks, which are trading even deeper below their support levels. That resilience speaks to underlying confidence in the company's fundamentals. Remember, SOFI isn't just a speculative growth play, it's steadily expanding its financial ecosystem, from lending to investing to now asset management products like ETFs. Each of these layers adds durability to their business model, making them better prepared for whatever macroeconomic shifts lie ahead. So where does this leave us? On one side, we have bearish pressure from institutions reacting to weak data, seasonal fear surrounding September, and technical signals of consolidation. On the other side, we have the bigger picture: likely rate cuts, expanding product lines, and signs that smart money isn't doubling down on bearish bets. In the short term, expect more volatility. In the long term, SOFI's trajectory still points toward growth, especially if the Fed follows through with easing policies. The launch of the new AI-driven ETF may not move the stock dramatically right now, but it shows that SOFI is paying attention to market demand and positioning itself for the themes investors care about. Timing could have been better. Perhaps a few months earlier would have captured more hype. But even now, it builds credibility. Slowly but surely, SOFI is crafting a reputation as more than just another fintech. It's becoming an all-in-one financial hub with global aspirations. At the end of the day, today's decline doesn't appear fully justified. It reflects more of a knee-jerk reaction to data headlines and September market psychology than a fundamental shift in SOFI's outlook. For long-term investors, these dips may eventually be viewed as opportunities. For traders, the key will be closely monitoring those support and resistance levels alongside upcoming economic releases. SOFI's story is far from over, and with institutions actively positioning, options traders leaning both ways, and the Federal Reserve's decisions looming, the next few weeks could be critical in shaping the stock's next major move. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.